All right, let's talk about La-Z-Boy. They just dropped their first quarter earnings, and wow, the market's reaction was, let's just say, not great. It was swift, it was brutal. So in this explainer, we're going to dig into exactly what went down, why it happened, and, maybe most importantly, what La-Z-Boy's game plan is from here. Let's dive in. So, just how bad was it? Well, take a look at this. A 14% drop in after-hours trading. I mean, that's not just a dip, that's a nosedive. A reaction like that tells you one thing. Investors were seriously spooked. So you gotta ask, right? What on earth was in that report to cause such a massive sell-off?
Okay, so let's get into it. To really understand what drove that sell-off, we have to pull apart the numbers. The market was really hoping for some sign of stability, especially with how tough things are for consumers right now. But that's not what they got. Instead, it was a pretty clear miss on some key metrics.
So here are the headline numbers that really set the tone for the whole story. First up, adjusted EPS. That came in at 47 cents. Now, Wall Street was looking for about 53 cents. That's an 11% miss. That's a big deal. Then you look at revenue, and yeah, it was also just a little bit shy of expectations. Now, you might look at that and think, hey, it's not that big of a miss, but you have to remember, in this kind of market, any sign of weakness, even a small one, gets absolutely punished.
But this is where the story gets really interesting because it's not all bad news. It's kind of like a tale of two companies within one report. On the one hand, you have some serious drags. I mean, look at this. Joybird, their online brand, sales down a whopping 20%. And same-store sales dropped 4%. That hurts. But then you flip the coin and you see some real bright spots. Their core wholesale business, margins are actually improving. New stores are adding growth. And get this, the balance sheet is an absolute fortress. We're talking $319 million in cash and zero debt. That's pretty incredible.
So, you've got this mixed bag of results, right? What's management's move? Are they pulling back? Hunkering down? Nope. Just the opposite, actually. They are doubling down on their big long-term strategy, something they call the Century Vision. And they're using that rock-solid balance sheet to go on the attack, to play offense while everyone else is playing defense.
And, this quote from CEO Melinda Wittington really sums up their entire mindset. She said, "I think it's important that we play offense even in challenging times, and because of the strength of our financial position, we're in the enviable position to be able to do that." So you can see they don't just see that cash as a safety net. For them, it's a weapon. It's what allows them to invest and get stronger when times are tough.
Okay, so what does playing offense actually mean in practice? Well, it breaks down into four big pillars. First, they're getting aggressive with retail expansion. They just made their biggest acquisition ever, buying a 15-store network that'll tack on about $40 million in sales. Second, and this is a big one, a total distribution transformation. They're going from 15 different centers down to just 3 huge centralized hubs. That's a massive project. Third, they're working on their brand reach, refreshing their look to bring in new retail partners. And finally, they're taking a hard look at the parts of the business that just aren't pulling their weight. Make no mistake, these are not small tweaks. These are major, major moves.
Let's double-click on that distribution overhaul for a second, because the timeline here is absolutely crucial for understanding the market's reaction. This is not a quick win. Management was super clear on the call. This whole process is actually going to hurt their margins for the next couple of years because of all the transition costs. The payoff? That doesn't even start to show up until year 3. And the full benefit, we're talking a really nice 50 to 75 basis point bump to their wholesale margin, that's not expected until year 4. So you can see why the market might be a little impatient, right? It's a classic case of short-term pain for long-term gain.
But that's the long-term vision. In the meantime, the company still has to survive the here and now. And the reality is, the current environment is tough. Management's own phrase for it is that they're dealing with a challenged consumer.
And the headwinds they're facing are no joke. Think about it. Housing transactions are near 30-year lows. And when people aren't moving into new homes, well, they're not buying new furniture. It's a pretty direct line. This isn't just a La-Z-Boy problem. It's an industry-wide storm that's slowing down foot traffic and putting the squeeze on basically everyone.
And you can see that reality baked right into their guidance for next quarter. They're guiding for revenue between $510 and $530 million, which, yeah, that's a little lighter than Wall Street wanted to see. But the really telling number is the operating margin. They're forecasting between 4.5% and 6%. That tells you that the pressure from those big investments and the tough sales environment, it's definitely not going away anytime soon.
Okay, so let's recap. We've got disappointing results, a brutal market reaction, and a really ambitious, long-term plan from management. So what does this all mean for the stock? Where does it go from here? Time for our final call.
And really, it all boils down to this one central question. How do you value a company that is willingly taking on some pain right now for a potential big payoff down the road, especially when the overall market is so uncertain? I mean, that's the classic dilemma for any investor, isn't it?
All right, here's our prediction for their next quarterly report. We actually think revenue could surprise a bit to the upside, probably landing in the top half of their guidance, thanks to those new stores kicking in. But, and this is a big but, we expect margins to stay squeezed down near the low end of their range as that heavy investment spending continues. So what does that mean for the stock? We think it's going to be range-bound for a while, basically stuck trading sideways between its recent lows and where it was before earnings. The market is going to be in wait-and-see mode. The one thing that could break it out? The key catalyst to watch will be any news on how that massive 15-store acquisition is being integrated. That's a huge piece of the puzzle.
So, with all that said, our final rating on La-Z-Boy is market perform. And here's the logic behind that. On the one hand, that fortress balance sheet and their bold long-term strategy, they create a pretty solid floor under the stock price. It's hard to see it falling much further. But, on the other hand, you have those very real economic headwinds and the huge risk that comes with trying to pull off these massive projects. That creates a ceiling, at least for the near future. So, the long-term potential is definitely there, but the short-term risks are just as real.
And as always, a quick reminder, this is for informational purposes only and is not financial advice.